All right. Good morning, everybody. Hopefully your holiday went well. We're back. Seeing a little bit of a fade from around the world. You can see all the US markets down in the bottom here. But we are setting up a little bit like a TRB. Could see a rally back after holding the half. We'll get to that in time. We got some job numbers coming in this morning. These aren't the big ones, right? That would be non-farm payroll, but any job number data at all you want to focus on, since the Fed's dual mandate is rates and employment. So once we're done with the initial jobless claims, we have auctions today, 11:30 and 1 o'clock. But like I've said before, if we have any auctions anywhere, just assume that there's 3 time frames for auctions and they'll all be used at 11, 11:30, and 1. We've already got some crude oil news at 11, so watching the clock at 11 anyways isn't going to be such a burden. Just put it on the list. All right, so I mentioned the ADR. If you look at the right side, we've got the ADR red, the lower ADR half. We came down into it, we rested on it, we really stopped fading there, had a little micro double bottom bear trap, started to rip back up. This is a failed bear flag and TRB setup. The purple line is the daily floor pivot, and the yellow box is the channel for that pivot. So we're holding, and there's a phrase that says if we get to one ADR early enough in the day, we can go to the other ADR by the end of the day. That would put us up at 6130-ish. That's the FOMC 6132 cog line that we've talked about before. It's the cog line, the liquidity gap from FOMC, and it's today's ADR half. So if we can get this party started, that's the base case argument right there, is we're going to at least go to 6132. We've got a VWAP to get through, which we've struggled with a little bit, trying to get through that VWAP. And if we do this the way we normally would, using something like the 786, we're already through it. Now, depending on how you like to do your 786, and you backed it up, we're still through it. We're just stalled out there. So we're done with the 786. We just got to get through that VWAP and then start working our way back up. There's a bit of a half back between the top and the bottom here that you could focus on as well. And then there's 6092 cog line. So you start adding them up, 6092, 6100, 6111, and then 6132, step by step, right? And then of course you've also got the Globex high, Friday's high, or Tuesday's high, excuse me, not Friday's. So far, everything looks fine. It has a bullish bias to it. Whether or not that sticks is, well, that's the $1 million question, right? So you can see how we've broken outside of the week's range and volume. We'd expect that to move up this this week maybe spread out a little bit. We had a really nice distribution in the lower portion. And now we've broken out of that value area high, and we're putting in a new distribution in the upper level. So this isn't a capital B. They actually consider it two different shapes. So there's the D down here with the profile. We're building a new D up here, and we'll likely put in a new point of control up here. It does fill in a lot of this shallow area that we got from FOMC. And you can see we still got the COG line and the liquidity gap marked from that FOMC event. It's last week's point of control, and it's the COG line, and it's the liquidity gap, and it's today's ADR half. You kind of get the idea, right? We're just stacking them all up there, 61.32. It's a significant level. It'll begin to act a little bit like gravity if we get within range of it. I've been thinking quite a bit about that range and what that means, what that entails for us. How close do we have to get before it begins to magnetize and just draw price into it? And I'm going to say when we start to get into this volume distribution shelf, right, this high volume node, this entire area here, we get into that and it'll likely draw us up into that 61.32. Yeah, you like it. Otherwise, if we break back down below 60.50, then cut through 60.32 cog line, back through the point of control on the week, 60.11, 6,059.92, and then on down. It would take some pretty nasty news to deliver that sort of move at this point. This is the cumulative volume index, and it doesn't matter what's at the top because it's not looking at whatever's up here. It's looking at the NASDAQ. Now, if you go to TradingView, they'll give you a choice to look at the S&P, the NASDAQ, the Dow, or the choice I like, they'll give you a chance to put all of the US markets together into one, right? The combined US markets. And then it will give you the same thing, the cumulative volume of all the US markets. I think that's better than what they offer here on Thinkorswim. But, you know, we take what we get. So the cloud is something I added to the indicator. It's a Bollinger Band. And then I added a couple of moving averages. What we're looking at here is a very aggressive cumulative volume. And since it's pointed up, we say it's net buying. If it was headed to the south side, then it'd be net selling. So cumulative net buying is still off the hook. I mean, this thing is Bollinger Band breakout on a weekly, no less, and just pointed to the upside like a rocket ship. Does not look like the ES at all, which is sideways, still stuck within last week's range, chopping just barely back above the 10 and struggling for new highs. If we did try to compare that to something like the NASDAQ, same thing. We're still inside of last week's range. We haven't broken out. We haven't got into new highs. It's not pointed straight up at all. So there's still a lot of net buying going on throughout the market. The indexes may not be representing that bullish bias and a lot of that buying opportunity, but it's there. There's ETF inflows that are tracked. There's liquidity, the perspective through bonds and treasury and yields, the VIX. So many things right now that are telling us there's still a lot of bullish buying going on. Now, there are some warning signs, risk has dialed back. We're seeing Bitcoin off its highs and fading. There's some other a little bit of short covering rallies. We got like GameStop is up. Roaring Kitty was out on social media hyping that up a little bit. So, there's some signals of risk, but that cumulative volume still looks crazy bullish. So we are really close to the 10-day moving average. We're messing around with the 20 right now. We got the 3-week right around that 60-50 level. A voodoo line up at 61.20. It's a long ways off. I don't see how it's going to be an issue for us right now. The call wall also up there. We would hit the call wall before we hit today's ADR. And if we continue that move to the downside, 60-50 is where the volatility trigger is. So it's another form of support. I really see 60-50 as being a significant level of strength. I expect it to hold. I don't expect to even touch it. But if we do, I expect it to hold. Maybe we cut under it, trap some bears and then rip back up again. But we're not even expecting it to be that weak. Just keep in mind, it doesn't owe us a move, right? I know everybody's looking for this big Santa Claus rally type move, but it doesn't owe us anything. We could chop sideways into the end of the day, the end of the week, right? Never really getting above 6,100 and never really getting below, say, 60-50. It sounds like a tight range, but that's 50 points, and we could just chop there for the end of the week. I know it's not what I want to hear. It's probably not what you want to hear. The 10-day, 30-minute volume profile has most of the distribution up here. So for each new candle that we get on the right, we're going to lose one off of the left, and it's all going to be across these highs. So while we're looking at this point of control overhead and we see it as a significant resistance, we're going to be whittling away through a lot of that volume, and it's going to dissipate. It'll end up underneath us somewhere. This doesn't look like very much. A nice little wolf look. It doesn't look like much until this starts to disappear. Then it will. Then it'll start to grow out and it'll look like a lot more than what we have above. We have a new VPOC on the week. It's from Monday. So a move to the downside has that to contend with. $23.5. Otherwise, from Tuesday, if we were to put it on there, we've already hit it. In fact, we bounced off of it, got a little Busby there, broke through it, came up to it from below. Now we're fighting to get back through it. I don't carry the previous day's point of control unless it's like what we have down here with Monday, where it hasn't been hit yet. That's what I'm interested in. That's what these are. They're points of control that we just haven't come back to. The one from Tuesday, we've already come back to it. We've already hit it. So I'm not interested in carrying it forward. But if you go through the textbooks and you learn about volume profiles and TPOs, the textbook will tell you to carry that line forward and then monitor it throughout the trading day today to see if we hit it and how price responds around that level. I've got enough pivots. I don't need another one. And then we have today's profile, right? So not just looking back at yesterday, we have today's. Where's our current point of control, value area high and low, and the TPO with its point of control and value area high and low. I don't really use those on the intraday either, other than just to get a little perspective of what could be overhead to deal with. And that's what we have right now, is what could be overhead, our own point of control, which will act like gravity if we get within its range or its zone. It's right at 6,100. It's a nice round number. If we get even close to that, it's going to draw us into it. There's a cog line at 6091. So get through the cog line, little shallow area, and then we get into this high volume node. Anywhere within that zone, it should just draw us right into that point of control. That's going to be the difficulty, right? Is if we're looking for a rally day, a breakout and a run and getting to the upper ADR, we've got to get through this point of control. And that may be the crux of the whole problem. You know, it's the reason we may end up sideways on the day. So if we can't get through it, they'll just sell back down into the 60-50 area, no change. 6,100, as we can see, is the week's expected move, which we made that move in 2 days. It wasn't much of an issue. And we've sold off from that. We're supposed to close inside this range 70% of the time because it's a 1 standard deviation. Now, the S&P has one of the most accurate expected moves ever, and it's from years of being ahead of the curve. When options only had monthlies, we got weeklies on the S&P. When everything else got weeklies, we got 3 times a week. And then we got once a day. And being ahead of other markets by years, the most heavily traded product consistently throughout the entire life cycle of options, it just has a very accurate expected move compared to everything else. So 70% is the low end. This thing can hit 80% accuracy for months at a time. It's happened before. So we expect to close inside this range 70 to 80% of the time. It doesn't mean we have to. You know, in fact, when we don't close on the week within this range, one time, once in a blue moon, it's not a big deal. Consistently closing outside the range over and over is a warning or a heads up. Like before COVID hit, when we started to have weeks repeatedly back to back where we were closing outside the box, something was wrong. And then we had a global crisis. So we're in the box. We got to the edge and we came back in. It's what we would expect. We can come up and test the edge today, tomorrow, but we would still expect to close within the range if we're going to do what we normally do, which is close inside the box. We're holding above the 10-week after coming down into it, starting to rise back up again. This doesn't look much like a wave. I get that. If you focus on the blue line, though, it is another representation. It's like an average of these histogram bars. The wave is there. The problem with the wave is it's starting to flatten out, right? We're not really getting that sort of distribution that we have been getting. It didn't go shallow enough or negative enough this year to give this that continued wave shape. Instead, it looks a lot like what we had back here. And that was a continued run to the upside all the way up into 2022, and then that bear market that dropped us off, which is where we've seen that distribution into the negative. I don't see anybody out there calling 2025 another chance to see 2022 bear market. There's some bricks in the wall of worry, sure. Most people are optimistic, though, with a sideways to bullish bias continued pointing to the upside. But there are some bricks to be concerned with, and one of those is the crowded trade with AI and the chip sector, and we'll just have to see how that goes, right? For the time being, and this can last years, maintaining like this above the zero line. It doesn't have to be a 1 year only and then it shut down again. So we're 1.7% above the 10-week. That's fine. It's a little shallow. It'd be better to get back above 2. But as long as we're not below 1, then we don't expect to go back to the 10. If we get below 1%, say if we're 0.75% from the 10-week, it'll start to act like a magnet and draw us into it. Then we get another bounce. Looking at the 10-day, we are back above it, but the wave here has been holding really close to the zero line, right? This is that blue line again. And we haven't been underneath it in quite a while, right? That August drop that put us down there. If we're looking at the blue line, it's been a bit since August. So even with this negativity that we got that dropped us down on FOMC, it didn't sustain down there long enough for the blue line to cross below the zero line. So the trend and the average is still in bullish bias. If you're not used to this screen, I get it. It probably looks like a lot trying to take it all in all at once. The top 3 charts are what we consider risk on. If the economy is doing good, if the market is bullish overall generally, and we're expecting more to the upside, then those top 3 markets are what we would expect to perform well. And you can swap them out for things. You know, it's technology and consumer discretionary, but you could also put in communications, chips, the Mag 7, or anything that fits along those lines. When we looked at this grid a week ago, everything but one was red. And it's looking at things over a 5-day period. Now, those big legs that we had talked about on most of these are still there, like building materials. Sure, it's a little bit of green now. I mean, like just a little bit of green. We didn't even get a dead cat bounce, a rip back in the other direction. It just fell down there and stabilized, developing a bear flag. So it can get a bear flag fail and rip back up, but at the moment, we haven't got that. If we were looking for a dead cat bounce, then healthcare would give us an example of that. You know, a deep fall and a rip back up to the half, retesting the 200, another deep fall. But then look at that pathetic little bounce there. Not much. So even if we were to get a bounce in something like healthcare, it's got to get through its own pivot point back here at 140. Nice round number. If it gets through that and tries to run, it's got the 50, and the 50 crossed the 200. That's a very negative, bearish signal. You don't want to see on a daily chart price under the 50 and the 200, and then the 50 cut below the 200. That's a bad deal. Looking at staples, price under the 200, trying to come back up again. 50 is not there, so it's not as bad looking yet, but it's not good. Utilities, at least it's still holding above the 200, but that still means utility has a price target at that 200, right? It's gotten close enough now. We'd expect it to just go ahead and finish it off. Financials, it's got that bear flag shape and it still has a gap down here that needs to be closed. But it's tangled up in the 50. It's holding well. This could recover from the FOMC and try to get back above 50 and just continue to do its thing. Why not, right? It did the same thing back here and it survived. Had issues back here and it survived. So it's possible. And if you look at the 10-2 spread, we're still holding above the 0 line in the 10-2 spread. So as they say, cheap and steep, then all right. If we lose that though, and the 10-2 cuts back down, then look to break 48 for a nice short to get this gap closed, and it puts 200 on the map. We've been watching 200 in staples and healthcare and utilities and consumer discretionary, or not consumer discretionary, but industrials, and all of those quote defensive names with no flight to safety in any of them. We don't want to start to see that sort of behavior in financials, technology, consumer discretionary, or this market's going to have serious problems. All right, so there's the industrials under the 50. It still gives us the purple line, the 200-day moving average, 130, nice round number. That's our target if this bear flag does not turn into a failed bear flag. All right, so you got the control bar, it's FOMC. The half of that bar is the breakover point. Get back up to where the bar started. That's the liquidity gap. Back above the 50 and work your way back up. Or we continue this bear flag and we get down to that 200-day. If you're looking for a short on this, low risk entry would be a short against that 134.5. It's the midpoint. It's the same place we rejected back here. It's the halfway point of the control bar. If it doesn't fail there, 136.5, I would say your short opportunity is as close to this 136.5 as you can get. That's what we call an LRE, low risk entry. Better to short from the high so you can use a very small stop as opposed to waiting for it to turn around, come back down, break down, and then try to short it from the low, because then where does your stop go? A long ways off. You have to put a lot more money at risk. The nice thing about this is the setup is the same on all of these. Building materials, it's already underneath the FOMC candle. Now it just needs to stay under that candle. So instead of using the midpoint, you could just use the close of that candle. Looks like we're back above it, so it's a start. If we're going to get a dead cat bounce and or a rally in the defensive sectors, then the bear flag has to fail so we can start the rip and the rally back up. If you're looking for an example of a failed bear flag, it would be right there. All right, you got your flagpole. This is more of a bear pennant, but whatever. Same difference. Bear flag, bear pennant, failed, formed a little micro cup, ran back up to the top, which is what it owes us anyways. So if we do get a rally in industrials, I don't know, in building materials, it's back to the 2. Energy, back to the 200 again. It's like $90. The thing is, we're not expecting any rally to be that strong or that sustained. Healthcare, same thing, back to the 200. We're talking weeks to make that sort of move, right? And it would be a flight to safety capital rotation out of the chips, out of the Mag 7, out of financials, out of tech, software, all of that. We'd see that rotate out and we'd see defensives rotate in. Looking at things that are down this morning, Bitcoin is down almost 4% in the overnight, and it's still down 6% in a 5-day period. So it was down, say, 3, and now we're adding to it over a 5-day period. XXX China is down 1%, but it's still up almost 9% over a 5-day period. So this is just a bit of a pullback on a bullish market. The Mag 7 up volume is down this morning, but it's still up 14.75% over a 5-day period. It's crazy bullish. It needed to rest, kind of take a break. Bonds are down. Biotech chips are down. That needs to change, right? We were up more than 4% in a 5-day period. Now we've pulled back a little bit. It's healthy. It's fine. But if we're going to get a rally today, we got to rally on something, whether it's chips or software, one or the other, or both. I mean, if we get both, that'd be a nice rally day. It doesn't have to be a dichotomy of either or, right? The VIX is up slightly, 7% this morning. It's still down 36.5% over a 5-day period because we had that VIX spike, right? So yeah, it's up a little bit today, but I wouldn't read too much into that yet. Precious metals are trying to rise, but they're not up enough. If we're using a benchmark of 0.5%, then we're not there yet. So we got a little bit of healthcare, but you can see it's just an algo print. Probably can't see it because it's just a tiny little print. It's way up here. So that doesn't count to me. Those little algo prints, it needs to stick and show us that it's going to stick. Otherwise, it can be like a dark pool print, right? Where you get one of these wild outsized bars that don't mean anything to anybody. Pot stocks were up a little bit. Seems like they're giving it back off. It's a TRB setup. Not expecting any move in pot stocks into the end of the year. It's the same old story here with these guys, right? It's event driven, and unless there's any talk about legislation or some kind of change, then it's going to continue to bleed off. It is worth mentioning that the MACD was extended negatively, and we've got a crossover and it's pointed higher, but that can take months to turn into anything fruitful. It's certainly not a buy signal. It's just showing that there's a slight bullish bias there, momentum wise. Crude gap up above yesterday's high, needs to stick, but it's fighting the year-to-date anchored VWAP. We've been fighting that VWAP for months. If we can get above it, there's really not a lot of traffic above 76, maybe 78, but that's a big maybe. It's just a lot of trash here with no real fruit to bear. Precious metals, gold, silver, all those guys, it's gapped up. We got a lot of algo prints, no real flow yet. Even if we get some flow, we got to get through that FOMC day. That candle is all over the place right now in different markets, but it is the dominant candle that we have to contend with. So call it 244 to get the gap closed, shoot above that FOMC candle, and then we could form the same kind of cup that we formed back here, right? That's what we would be looking for if we can get through that FOMC candle. It's a big if. I don't see it happening in a day. We would need a lot more out of the markets than I think we're going to get on holiday flows. And look at GDX, it's still resting on the year-to-date anchored VWAP. So it's continuing to bleed to the downside anyways. It is worth mentioning holiday flows, right? Lowered volume gives markets a chance to make big moves. And if you're newer to trading and you don't quite grasp that, I get it. It can sound counterintuitive, but low volume means that market, if you want to buy or sell, you've got to reach higher or lower to find someone willing to take the other side of your trade. And that can make price move really fast and go really far. So while our base case argument is we're going to hold the line, get to the upper ADR, not really get some wild breakout day, but just maintaining our bullish bias and not break down. Keep in mind, one tiny little trigger can spark this market and we can rip or dump a considerable distance. There are a lot more things that are negative this morning than positive, but the things that we need to be positive, because if you got things like pot stocks, airlines, solar panels, that's not the kind of stuff you want up for a bullish day, right? You need the Mag 7, chips, tech, software. That's what you're going to want to keep your eye on today. And they're slightly bullish. They're just not enough yet to meet our qualifications. That's what I got for you guys. Be careful, be safe, enjoy your holiday week. I'll see y'all tomorrow.